My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I like people to make friends, just trying to make you some money. My job's not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. If the consumer is confident, then I'm confident, at least about business. We are a consumption-based economy in this country. You know, 2/3 of our commerce revolves around the consumer. So what matters most is whether the consumer's tapped out, fatigued, worried, or just still spending their darn fool head off. Right now, you can feel the confidence somewhat draining out of the system. Even on a pretty good day for the market, where the Dow advanced 336 points, S&P gained 1.65%, and the Nasdaq jumped 2.14%. What a comeback from an hour before the close. Lack of confidence is behind the run on this regional banks issue, and don't kid yourself. These are actual runs. Lack of confidence is behind the big decline in retail spending. Those numbers have just been awful. We're out of confidence when it comes to commercial real estate. I fear we're going to see a massive retreat from those office towers, as few executives seem willing to force people back to work in person. Of course, though, there are still big pockets of confidence, and we got plenty of them. We've just got some good numbers from a small business confidence index this morning. They are still confident about their prospects. We know that housing and autos are still humming. And travel, it seems it goes to no end. I call that the long on money, short on time trade. As people looked into the abyss of post-COVID and decided, damn the savings, let's go somewhere. It's an extremely full plane. Let's live it up so as long as we can, because life is too short. No wonder airline ticket prices increased 6.4% this morning. That was the most pernicious part of today's otherwise, let's say, benign, tolerable consumer price index. Perhaps more important, as a chart that I saw, a chart that really kind of blew my mind. It was from Katie Huberty. She used to cover Apple. She pointed out from her perch now as Morgan Stanley's global director of research, a chart which shows that, and I quote, consumption has been resilient, but shifts in how consumers fund spending may augur a slowdown, end quote. Or in English, based on new data, it looks like consumers have spent their excess savings that they have from COVID, and that means, quote, consumption is set to soften in coming quarters. Huberty notes that credit card usage, quote, has risen across the board, indicating that it is not only subprime borrowers tapping into their line of credit to fund spending, end quote. And that's worrisome. See, if the consumer gets tapped out and confidence wanes further because of things like what happened with the banks last week, then the Fed can't afford to continue raising interest rates. That's good. We're still not seeing the massive layoffs that the Fed wants to crush wage inflation. We're still paying some absurd prices at the supermarket, even as the new CPI showed poultry, beef finally leveling off. Now, don't tell that to my wife, who paid $1.87 each for 4 Honeycrisp apples at Target this afternoon. Highway robbery. But which highway? The Apple Company? Target? Both? I'm focused on confidence, though, because that's at the heart of the most important issue facing this market, the rise and fall and possible rise again of the regional banks. The regionals rallied big at the opening as a senior Treasury official told our own CNBC Steve Leisman that there's an implicit guarantee that depositors will be made completely whole at any bank that fails. Now, I've seen many a bank failure in the 40 years since I got in this business. This is the first time I've seen actual deposit gigantic outflows, with the exception of the Great Recession. What we're seeing now are indeed old-fashioned bank runs, but with a modern twist. In my lifetime, bank runs usually stem from the firm not having enough equity on its balance sheet. They don't have enough capital at the company level. This time, it's about deposit flight, kind of like what we saw in It's a Wonderful Life. Yeah, where the Bailey building and loan almost fails, and actually, in that scary dream sequence, that really does. Yet, because of the ease with which deposits can go from one bank to another, thanks to modern online banking platforms, it's quite easy to wipe out a regional bank with a few well-placed tweets and some cell phones. And that happened! Sure, there are lines around the block for ATMs, but there's also billions fleeing through the touch of a screen. I think it's worth dwelling on this point because we got a nice reprieve today. I'm going to be beaten down, bedraggled regional banks, so nice rebounds. Not back to where they were, though. I'm still concerned that our newfound lack of confidence in the banking system, coupled with the tapped-out consumer that Katie Huberty talked about, makes it imperative for the Federal Reserve to pause after it raises interest rates by a quarter point next week. That's the expected plan. Don't want to deviate from that plan. That shows to be fearful. Look, I have been close watch this show know this. They're a bigger supporter in this country of Jay Powell, our Fed chief. I have been with him the whole way in his quest to beat back inflation, because that's how you destroy the power of the savings of the working person. Until last week, I figured he had to take rates to 6% to get this done. I thought that would be prudent, and I said so on air. But you know what? I now believe it would be reckless if Powell goes much beyond 5%, at least now, where we'll be with another quarter-point rate hike, because what I saw last week, I think confidence has been deservedly shaken by these bank failures, and it's time to take pause. We don't have enough information to say that deposits are safe in any given regional bank, because right now it depends on how that bank bonds are doing. I mean, how's the portfolio situated? Not something you want to consider when you say, oh, gee, I want to know if should I put my money in that bank. How's their held to maturity? How's their helpful service? We don't do that in this country. If they have losses on their bonds and the ratings agencies or the examiners question their portfolios, well, you might not get your money back, at least as fast as you'd like. There may not be enough confidence left to stay put. Maybe you take your money out of your bank altogether. That hurts national lending. Now, you could say, who cares? There are plenty of groups that might have much exposure to the broader economy. Hey, maybe you like tech. But go read Mark Zuckerberg's incredible epistle, where he nailed on the Meta platform's door today. There are more layoffs coming in tech. He's at the vanguard. He's got horse sense. I like tech. But I'm not oblivious to how economically sensitive this industry's become. I think they're rallying because the market's oversold. These stocks look cheap if inflation's under control. And when it comes to the Fed's next move, do you think that they'll take into account the coming layoffs from Silicon Valley? As hundreds of startups may have just had their lifelines pulled by the collapse of the Silicon Valley Bank? I don't know. There are cross currents everywhere. We know housing's still strong. So a fantastic set of numbers this very evening from Cramer Lennar, the giant national home builder. Monster top and bottom line beat while giving us some stronger than expected forecasts for orders and deliveries in the current quarter. While that's great for Lennar, it's actually not what Jay Powell wants to see. Housing's just refusing to roll over and play dead. And that's because of a structural issue. We don't have enough homes being bought or for sale to do so. It's not really trading as much with mortgage rates as it used to. On the other hand, commercial real estate, at least the second and third tier buildings, getting clobbered, in large part because few CEOs besides Zuckerberg have the guts to say that people must come back in person every day. Well, he said, kind of made it sound like if you don't come every day, you may not have a seat at the job. But that's what's killing the real estate investment trusts that own these tertiary towers. So now, for a second, what I want to do is I want to put it all together to sum it up so you really understand why we could rally and yet why I'm concerned. Until last week's banking fiasco, I think Jay Powell was losing the war against inflation, losing it. But the collapse of some highly visible banks, the fault that could cause the folding of a great number of startups, and the possible tap out of the consumer as savings seem to be ending, and now spending is actually from what you have when you make it money, that means credit card debt, makes me feel that the plane is on the cusp of a soft, safe landing. Bottom line, we don't want the Fed to turn a potential soft landing into a hard one just because of some jacked up airline ticket prices, a couple sticky home costs, and yes, a few rotten apples selling for $1.89 a throw. Chris in Ohio. Chris.
Hey, Jim. Good to talk to you. I've been a fan of your shows for years. I have a question about Huntington Bank. I have a question about Huntington Bank.
I think that Huntington Bank at $11 is a buy. I think that Steve Steinauer is doing incredibly well as a CEO. I think it's what I call BAU, which means business as usual, with a 5.6% yield. I think that this is one that if we didn't have financials for the Travel Trust, I would indeed buy some of this because it's down almost 30% in the last month. It's a well-run bank. No outflows to speak of last week. Let's go to David in Virginia. David.
Booyah, Professor Cramer. I hope you're doing well. We need to hear from you during these times.
Thank you, buddy. Sure.
Hey.
I was going to take a little more time off, but it seems to be ill-placed, but I'll get there. What's up?
Hey, news reports that Boeing has reached a deal with Saudi Arabia for up to 121 airplanes and also in talks with Japan for sales of their 737 MAX. Is now a good time for me to add to my holdings in Boeing? Yes.
Dave Calhoun was terrific today. Phil LeBeau interviewed him. I really like what's happening at Boeing. It hurts me. My child trust sold it, but you got to own your mistakes. This one I should have held it to all the way. because it's going to make a big comeback. All right, we don't want the Fed to turn a potential soft landing into a hard one. Now, man, tonight we got Honeywell. They just announced a new executive succession plan, a little surprising. I'm learning more about what investors can expect in the future from the company's outgoing and incoming CEO. And on Sunday, various government agencies they tapped into this thing, all these different acronyms. Well, tonight I'm going into what the nitty-gritty really was. You need to know this stuff. And could chemical giant LyondellBasell give your portfolio the reaction investors would hope for? Nice yield there. I'm talking to the company's top brass fresh off its Capital Markets Day. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.